Rotation. New age market dynamics. I think the biggest risk right now in the market is that the risk premium is at zero. And it's red just the way it was back in the peak around 2000. You are not paid to be in the market relative to the 10-year US Treasury. And another way to view this is if you look, this came out of JP Morgan. If you look at the forward PE on the S&P 500, it's around 22. And historically, for the next 10 years, that has resulted in somewhere between a -2 and +3 type return for the S&P 500. So if you're betting based on history, odds of doing really well by putting money into the S&P 500 aren't compelling. And with looking at the last 40 years, typically people would say you should get 10% in stocks. So I don't think that looks compelling. Another is that we are at a bubble. I think that's especially true in terms of the Magnificent Seven. And this is a chart from Crescat Capital, two of them, in fact. And right now, when you look at the market capitalization of the largest companies, the Magnificent Seven, it's at 62% of GDP. And that's really extraordinary. In fact, one way to think about it is if these stocks were to continue to grow, they would become larger than the total U.S. economy, which of course is crazy. So historically, it just suggests that the value that is now being attributed in the financial markets to these stocks in particular is excessive and it's unsustainable, which is my basic view, which is why the market's going to rotate and go elsewhere. One of the problems is we have inflation. Everyone's saying inflation is going down, or they've been saying that. That's kind of cooled off, and that could be a problem. And so we don't know that bonds will necessarily rally. They've rallied the past week or two based on some weaker economic data. But if we have high inflation, if inflation does not go down, then bonds are not going to do well. They've done well recently because there's been a perception that the economy is slowing. And I like to look at the market in terms of a long historical horizon, where basically over the last 40 years, we have seen interest rates as a 10-year Treasury going from almost 16% to 0.5%, and now it's moved higher. And I think that we don't know that they will go down. And if we knew interest rates were going to go down, then bonds would be a good bet. But I'm not sure that they are, and that's particularly a problematic bet if we have inflation. The size of the debt relative to the GDP right now is the largest it's been since World War II. It's about 120%. And the debt, the interest coverage on the US debt is now larger than what we're spending on defense expenditures, which is extraordinary. The last factor that I think when I think about market cycles is that we're in an inflationary cycle. And typically after major equity market booms, you have a period where inflationary assets do well, and that's what is shown on this chart. And what's working right now, we're seeing gold do well. Another area that's done well during these periods following the 2000 bubble were the emerging markets, and you see that here. Also, here is 20-year chart on China, 25-year chart on China. China did very well in the early 2000s. It's pulled back, but it certainly looks washed out. The peg on that is about 13 versus the S&P 500 at 31. And another area that will do well, we think, will be energy and materials and mining. And lastly, for a client, I recently put together a portfolio where we have this idea that we are.
I'm looking at the Japan stock market overvaluation versus the yen undervaluation. The second one is the US tech overvaluation versus China tech undervaluation. And the third one is German versus Hong Kong stock markets. I'll just go very quickly over summaries and charts. And typically, I'm not a short-term trader or advisor. I'm not a long-term trader or advisor. Usually, I work positions a couple of months, from a couple of weeks to a couple of months, and my expertise is really in option strategies and hedging. But these strategies, this is one of those colossal disruptive periods where there's going to be big shifts, and these seems to be very ripe. So if you're looking at options, then we're talking leaps, like strategies that should start working in the next quarter and should be good for several quarters, several years. You can never time it, but definitely the shift is happening. Here are the charts, basically, that weekly and monthly charts of I used the Japan ETF and
Can you increase the size of those?
Sure.
Yeah, there you go.
Is this better?
A little more. There you go.
On the left is a 5-year weekly, on the right is a 20-year chart. And, the weekly could look good, but generally this extreme difference between the two hasn't been recorded yet. And there's an inverse correlation between the Japanese yen and the Japanese stock market. Just in quick summary, again, this is a pure undervaluation play of Japanese yen and Bank of Japan risk, because what we've been looking at, this whole actually trade started with the squeeze of the carry trade. A lot of people claim on it. I don't think the carry trade's there anymore. I think the ascent of the Japanese yen was pretty much squaring off a lot of the carry trades, which are really arbitrage and not a long-term plays anyway. But this has really set up this trade. Again, I'm not going to get into how you trade it. I have some recommendations here, but I'll leave that for later. The second trade, I'm just going to go very quickly over this, Tyson, so I don't just spend too much time on one trade.
Yeah, just high level, please.
Yeah, just very high level. Now, the second trade is the China tech undervaluation versus the US. Again, in these situations, although the NASDAQ and the tech stocks in the US seem very overvalued, but it's stepping in front of the freight train. But the spread differential is dramatic. Again, there's a fundamental key going around here. Generally, at all levels, Chinese markets are turning around. And I think the Western perception in media has been very censorship-like and very misunderstanding of how Chinese economy and markets work. So I'm very much pro-China on this. I'm very much against the U.S. stock markets, especially the technology market. Again, if you look at these spreads, I looked at KWEB ETF, but I also paired it with Alibaba because I think Alibaba is the biggest representative and the most liquid stock that I would actually be buying if I'm looking at stocks versus ETF versus the NASDAQ. I mean, these are extreme. I mean, very often people look at some kind of reversing points from history. There is none. But given the macroeconomic situation and given the valuations, it's very unlikely that this trade the risk reward is just too great to pass on it. Is there the risk? Of course there is. Spread might continue to grow higher, but very unlikely given the valuation and macroeconomic factors. And my third trade is actually, speaking of China, I'm very, very bullish on the Hong Kong stocks. And there's a really like a geopolitical and valuation play with the Hong Kong market. The valuation, actually Hong Kong market is valued less than I don't know what is it right now. 2 weeks ago there was like a 2-3 point differential in the PEs, but they're very undervalued, and yet Hong Kong is a financial center. It's a very liquid, very mature market. with very good stocks in it. One thing that caught my attention with Hong Kong is that, and I know actually when I started trading, I traded in Hong Kong actually. I was a currency trader. And that was the time when Hong Kong was being just in the process of passing on ownership to China from UK. So I was still under the UK authority at that time. I think Hong Kong actually experienced a second downturn with a lot of clamping on mainland China and Hong Kong, freedom of speech, and all kinds of other things. I think that was a little bit overblown as well. Hong Kong is experiencing an extreme renaissance in the last few years because it's officially becoming the financial center of the BRICS. And it's also very acceptable and accessible by Western standards, US and European banks and businesses. So I think there's an incredible surge of IPOs, incredible surge of international companies and bank flocking into China. And there's going to be a multiple benefit, not just the financial sector, but generally industrial sectors, financial sector, technology sector. I just think Hong Kong is just hard to pass. And I've been always a big fan of Hong Kong, even those days when they were passing it on to China. Just a little flashback. This is like 3 decades ago, even more. Like actually, it's almost 40 years ago. That's where I started my career. It was unimaginable for me. Why was anyone rushing out of Hong Kong? Because generally, my perception, I was right on that China would just make Hong Kong even better and make it a financial center of the entire China. That didn't materialize quite well, and there was a lot of friction between Hong Kong and mainland China. Again, a little bit overblown, but I think this renaissance now is bigger than ever, in my view. So again, just to hedge my position, on the other side, my most hated stock market is Germany. And we all know that the European problems and the deindustrialization of Germany and whatnot, yet the market has been surging in Germany, and I'm cheering the German market going down for simple reason because there's going to be more room to go down. Germany is an absolute mess, and the recent election is really just a confirmation of their mess. So basically, the German election, what came out as predicted, it was like a coalition of losers actually in power. Absolutely nothing will be done in Germany, and they're actually going to be divided more than ever. Now with the Trump policy of pay your bills and we're getting out of here, Germany's a lose-lose situation. So this is my favorite trade, actually. Well, my second favorite trade. My favorite trade is actually yen, Japanese stock market versus yen. This is my second favorite trade. My most hated stock market and most loved stock market.
Mitch, I get the idea that you don't like Germany, but I'm looking at these charts. Is there a German index there that I should be looking at?
Yes, EWG. EWG is the orange one.
Okay.
The orange one is Germany. And you see a little ascend here. EWH Hong Kong is the Cayenne one. It's hard to see. Let me blow it up a little bit more. Now this is Tencent. I pegged this Tencent as one of my favorite tech companies, also listed on Hong Kong. So that's a little mistake because it skewed this chart. I apologize for that. But generally, if you look at the 5-year chart here, you can see that the Germany has been actually going back to the new highs. Hong Kong was sticking to the new lows. Again, this is not a predominantly a quantitative tech spread reversal trade. It is, among other things. This, for me, is a very significant event and macroeconomic factors that are going into play, both negative on German side and both positive on the Hong Kong side.
For what it's worth, I'll just chime in here. The evolution of electric vehicles, EVs, has had a decided benefit and advantage going to China and very much against Germany, because Germany has all these major luxury car manufacturers, and they're making some transition. But I think that you combine that with the Trump effect. Yeah, I think the argument that Germany is going to be struggling makes a lot of sense. So, for what it's worth, that makes a lot of
Well,
sense.
let me add to that because I can give you a whole clean laundry list for Hong Kong and a very dirty laundry list from Germany. One of the reasons you see this kind of ascent of the German market is because everyone's playing on that relief effect of the end of the war in Ukraine. And that might well happen, but there's actually no benefit for Germany there, and all their troubles are really going to come out at that point. I think the whole effect, the after effect of the war in Ukraine and as pull out of the U.S., even to U.S. troops, which pretty much the new Secretary of State announced, is going to really be hard reality hitting in Germany. And I predict that hard reality is going to start kicking into the second quarter. And there's a lot of things going on. I know German markets in the business very well. And it's absolutely nothing is clicking. Their leadership is absolutely very provincial and with an incredible dose of naivete. And now this election just divided the country totally. And it's just, there's no way out. And we know if Germany sinks, the European Union sinks. So you put on top of that, like the icing on the cake with Trump and all these statements that came out from him, Secretary of Defense and J.D. Vance, and then you got the really, really lethal mix. And yet the market's going up, which is actually great. But that's not how these finales of peace deals work in reality. So this relief rally has no sense at all. Has no legs.
So the bottom line is, it would be a great setup in about 5 months, presuming that the Ukraine war becomes negotiated to a settlement, because right now there's this false benefit of the war ending, but the other fundamentals are really quite bad and not priced into that market at all.
Yeah, exactly. When your house burns down, that's painful. But then when you put a list of what you have to do and how much it will cost you to put it back on, actually is a much harder pain. And that's what Germany is going to experience very fast.
So, Mitch, are you done, or should we start going to questions? I'm sorry if I said.
No, well, one more thing I want to mention, something to keep an eye on. This is not in any long, short, or medium-term recommendation. But one thing, I shared this, Tyson, with you. I did a lot of research on gold. I'm just going to very briefly mention it. There's something going critically. Okay, gold is very bullish, and there's like a million reasons. There's people coming out and saying, well, I agree, it is bullish, but maybe it's tough to buy it at these levels. People are waiting for pullbacks, whatnot. But there's another thing that's happening with gold. We know all the factors, the inflation, purchasing powers from these junk currencies, including the dollar, geopolitical issues, central banks buying. We know all that. That's very bullish. How much of that's priced in? It's one thing. One thing that's not priced in, and that's happening as we speak, is the shortage of gold and the whole disaster, the all other disaster going on the gold exchanges, primarily on the COMEX and LME. That's something to watch. Here, I'll just give a couple of pointers. Right now in COMEX, there's 100 paper claims, 100 1-ounce paper claims for every ounce of gold that exists. Okay, this is not even musical chairs. Musical chairs usually 5 people, 4 chairs. This is 100 people in 1 chair. So what is going on now is basically the question is, how much gold? COMEX really doesn't have gold for delivery, and they've been actually emptying the vaults from London Metals Exchange because they needed desperately the gold. What is actually going on here? This whole thing started when Chinese cleverly set up the Shanghai Gold Exchange that settles exclusively in gold, and every paper has to have a backing of gold. So every ounce of paper in the Shanghai Stock Exchange is backed by 1 ounce of gold. So that is one of the reasons that the Shanghai Stock Exchange is a premium of 50. I think recently now you're in $100 premium to gold to the U.S. stock, to the COMEX and LME, which cleverly attract a lot of big hedge funds to start asking for delivery in COMEX and then taking that gold to Shanghai. Now you can imagine that's just accelerating the pace of gold moving from west to east. But if we have a crackdown, if we have an elephant in a glass shop and there's actually no gold to be found, and to put the fire in oil is the next is the actual audit of the Fort Knox that Elon Musk is proposing, and I heard some rumors it will happen on Thursday. If this does happen, and if this reality really sinks in, and 100 people who own paper that says you have a claim on 1 ounce of gold start going for an exit, then we're talking about a couple of weeks gold going from 3,000 to 5,000. Now, is this going to happen? Probably not, because everybody, including Trump, are going to do everything to shut this down and make a smooth transition. But by any chance, if they cannot do this, then you're going to have an absolute blow up, of gold to 5,000. That's what I think would happen, and you can just imagine the correlations and the consequences this would have to the rest of the markets. Again, this is a very, very dangerous situation. Hard to predict if and when it will happen, but I would closely monitor what's going on in these exchanges. And I think, again, this whole concept, the way Shanghai Gold Exchange set up its parameters and its exchange and actual link paper to gold, was a brilliant idea. And eventually they'll cherish on it. And where LME and COMEX are going to end up and how they're going to impact the market, we can just guess.
Well, I think that's a brilliant idea. I think that's something I had been hearing a little bit about, that, there was not enough gold at the LME. And, it reminds me that, the Hunt brothers created a huge squeeze, and I think it was
silver. Yeah, silver in the 70s.
And the idea that suddenly with this market, you get a big run, would be great, because I've been keen on gold, and I know Tony is. Why don't you finish up, and then Tony has some comments and questions.
I have, yeah. That's pretty much that's all I need to say.
Okay, Tony,
I'll stop sharing.
Okay. First of all, I would like to disagree with Mitch on Germany. But basically, I would disagree on the EU. And the reason I would disagree on the EU is because everybody is negative on the EU, just the way they were negative on China a few months ago. However, I think a lot of good things could happen in the short run, and they're all related to peace in the Ukraine, which I think is coming. And basically, there are two things here. First of all, an enormous amount of money is going to have to be spent to rebuild the Ukraine. The other thing is that sanctions are going to come off Russia. And if sanctions are going to come off Russia, the EU's energy situation is going to improve significantly. And the third thing I'd mention is that I think this whole gambit of Trump and his tariffs is going to trying to find the word. It's going to backfire. And what's going to happen is that the countries that are tariffed are going to put in countervailing tariffs. You're going to get inflation in the U.S. You're going to get recession in the U.S., partly because all these firings are having a very bad impact on consumer psychology. And I think the EU is next to Ukraine, and I think the primary beneficiary of all this is probably going to be Russia, but economically. but China is going to benefit and the EU is going to benefit. And it's impossible to invest in Russia, although I would if I could. So I think that selected stocks in the EU are really interesting. Now, I haven't yet gotten to the point of analyzing where I want to be. Um, the two companies that I've started to look at that I like as companies, although I'm not sure yet about their stocks, are Siemens, which is a German electric company, and a year or so ago, I read a conference by the CEO, which I found very impressive. And the reason I found it so impressive was that he is concentrating on the long-term strategic issues as opposed to stock buybacks in the next quarter, which is the big topics here in the USA. And I mean, Santander has had a big run. However, I think the Spanish banks are probably the best in Europe, and these people have done a tremendous job. So if we're going to get some kind of a renaissance in Europe, to me, um, these two um, these two companies look interesting. Although I haven't bought any yet. I'm going to study them more. Um, I really I've been a long-term bull in gold forever. I'm still a long-term bull in gold. I think this audit of Fort Knox is a canard. The reason I think it's a canard is because all the gold might be there, but it might have all been sold off in the futures market, which if that were true, it would look a lot, the situation would look a lot better than it is. So uh, I'm I'm very I'm very negative on the US. I'm very negative on the on the Magnificent Seven. I think a lot. I mean, I think what Elon Musk is doing to Tesla is a crime, and I think the stockholders should sue him, but they won't. I also think the NVIDIA conference call was mediocre, and the stock should be down at least 10 points, which is not happening. I think um, I think Europe looks interesting. The one group that I really like is solar, because I think that solar is going to have a major impact on providing power for data centers. And there have been a couple of articles written about solar microgrids. And one of the reasons that solar microgrids are so interesting is that they're contained, and they would not require upgrading of the whole electrical universe to power AI centers. Um, one stock that I think is really forgotten and interesting here is Silver Corp Metals, which is a low cost, high quality silver producer in China. They made a recent gold discovery. I bought the stock a few months ago at 460, and right after I bought the stock, they announced a convert, and the stock lost 40% of its value overnight. But it's very undervalued. It's got they got some great deposits. They also are rumored to have made a big gold discovery. So I think the stock's very undervalued.
Thank you, Tony.
Thank
Just
you.
have a reply to Anthony. Anthony, I never recommended to sell Germany. I recommended sell Germany, buy Hong Kong. It's a totally different trade.
Okay. Well, I like Hong Kong, and I think I like Europe.
Well,
Uh,
let me give you just a quick 15-second comments on your positive pointers in Europe. I see where you're coming from. There's a lot of if there, if this, if that. So if every if is 50%, and there's really maybe a 5% chance it's going to happen what you say. I tend to believe that. But one thing that I'll give you credit for is for Siemens. I think if any company is good in Germany, Siemens is as best as they get. But everything else you're saying, yeah, ifs. But that's a very hard risk reward
well, look,
proposal.
I think that the end of the war in Ukraine, um,
It's already priced in. It's already
I
priced in.
don't, yeah, okay, that's where we,
That's why I like the trade, because something's priced in that shouldn't be even priced in because it'll have no effect.
well, that's where we disagree, but that's
Well,
fine.
time will tell.
Yep.
All right. Well, what I want to do is now move on to Charles Zhang. Charles is a guy who has worked with me for um, a long time. Brilliant kid. I call him a kid because he started as an intern, had double 800s on his SATs. And Charles, are you there?
Yes, I am.
And what Charles has worked for a couple of quant shops, and we are going to do a separate quantitative separate account alternative strategy through Interactive Brokers. We're still putting the final touches on it, but he has a very interesting strategy that's simple, and for people who are interested in a quantitative hedge fund like strategy, I think he's got a lot of experience and he's going to go through it. Fire away, Charles.
Sure. So, hi everyone. I will give an update on our post-earning announcement drift, or PEAD, quantitative strategy. So essentially, it's a systematic approach. Try to identify and capitalize on delayed market reaction to significant news while emphasizing on risk management. So looking back over the past 2 months, you have noticed increased market volatility and choppiness. So in periods like these, our strategy takes a very cautious approach. So in fact, for the last 2 months, our P80 strategy has been highly defensive, holding primarily cash. So this is not a sign of inactivity, but it's rather a core feature of our approach. So a critical component of our strategy is it's a risk management overlay. So this overlay acts as a filter, evaluating overall market condition to determine if they are favorable for risk taking. So for example, we monitor key market indices like the Nasdaq Large Cap Index and the Russell Small Cap Index. Everyone can see the slide here?
Yep.
Okay.
Triple Q.
So NASDAQ is a good proxy for institutional risk taking, while the Russell is an effective proxy for speculative like risk appetite. They are particularly relevant to momentum growth stocks. So in the case of a NASDAQ, or in this chart, we have observed flattening longer-term moving average and the short-term moving average crossing back and forth without a clear trend. So this indicates a lack of upward momentum and a high risk of false breakout. Let's move on to Russell. For Russell, we're seeing price consistently below the short and longer term moving average, indicating anyone invested in the past 3 months are now in the red, losing money. So until this changes, the path of least resistance is to drop even more. So in addition to the broad indices, another component of our risk overlay is tracking leading speculative groups. On this slide here are some examples. They include social, space, nuclear, fintech, software, consumer, and e-commerce. Here are some of the representative names. As you can see in this slide, many of these experience parabolic price movement at the start of the year, followed by a very sharp downturn. So overall, I mean, healthy and sustainable price movements are gradual direction movements. They're never parabolic. So this pattern really reinforces our cautious outlook. Our current high cash position reflects the market risk overlay at work. That the present condition is not conducive to our strategy criteria for aggressive risk taking. The beauty of a quantitative strategy like ours, it's objectivity. It's not about guessing market direction, but responding systematically to what the data is telling us. So by remaining really patient and primarily in cash in period like this, I think we're positioned to capitalize when market conditions become more conducive to our strategy. That's all I have. I'll pass on to Tyson.
So that's great, Charles. And what I'd like you to do is just go back one slide. I thought it was very interesting, those groups. So social. So you got Facebook and what is that, Reddit?
Yep.
And then in space,
Rocket. The first one is Rocket Lab.
Rocket Lab. Okay. And nuclear, that's interesting. Fintech. Those are all very fascinating, and you track those. One thing that people may not realize on this call was Charles had a very impressive fourth quarter, and I think he was long both MicroStrategies and Tesla in the fourth quarter and got out of both. The idea is you want to capture the up move and then exit. And the strength of the strategy that he's been developing here is that you're not always in there, but once you have a certain event, it gets triggered, and then you can often get a great momentum move. And I can see a lot of these stocks as compelling. Palantir, boy, I missed that one, but makes a lot of sense. But it's interesting the way you track all of those. Are there any other questions? This is open. This is to the whole group here. Does anyone have any questions?
Hey, Tyson.
Yes.
I've got a question for Charles. Maybe he could expand on his strategy to go short when
I'm sorry. Who's
Well,
speaking? I'm. Who's speaking?
It's Mike Portnoy speaking.
Oh, hey, Mike. Go ahead. Repeat the
How you
question.
doing? Yeah, I'm just wondering if Charles can have an opportunity to short some of these stocks that he sees rolling over. I mean, he's getting great returns on the upside. Is there any opportunity to make money on the downside as well?
The strategy is not entirely symmetrical. since the down move happens much faster, you need to have like much more like reaction time. So I need to really change my strategy around to fit the short side. So that would be a separate strategy. It would be like more labor intensive compared to this one.
Well, for what it's worth, that's sort of some of the stuff that Mitch is looking at, or we're that's one of the benefits of some of the things that Mitch was looking at. I'm going to just read quickly. We often have Cheng Q, and I kind of discovered him in 2003. Went to Columbia as well. I think he's got a degree in nuclear physics and worked for a hedge fund for a while. And he had been talking about the Chinese stocks, and I asked him to write a note because he's.
Hello, Madalena. How are you?
I'm going to have to mute Tony. Okay. But this is what he said. This past weekend, Trump indicated further restrictions. Tony, I've got to mute you.
I have a conference call. So
now he's muted. All right. Can everyone hear me?
Yes.
Okay. So Trump indicated further restrictions in tech export to China, a likely modification of tax treaty with China, and further restrictions to investments in China and U.S. listed China names by various U.S. funds. In addition to more tariffs are likely. All these led to a great deal of uncertainty on investing in China and China names. It's unclear what the final versions of these proposed changes will be, but it looks like the administration is pushing for further decoupling of the U.S. from China and the China supply chains. This trend is worrisome for investment in China. On the ground, the renminbi remains has good buying power. Hotel stay is cheaper than before the pandemic, and in Beijing, it's $100 a night. He likes the China Weibo, which is the Chinese Twitter, symbol WB, remains one of the most influential social media names in China. Even under tight media control, the stock is trading at 16 times 2025 earnings. And while analyst expectations of flat growth is not high, he thinks that the downside risk is very low. So 6 multiple certainly supports the idea that China is very cheap. PDD, one of China's top, it's kind of the Amazon of China, one of the is currently trading at 10 times 25 earnings. And if President Trump adds tariffs to small parcels, PDD could suffer some growth, and they own Temu, Temu. And I'm not sure whether you guys have seen that, but I think that Tony has mentioned in the past liking BYD and Daiquo New Energy, the solar play, but I think those all make a lot of sense. So I'm sorry I didn't mention those previously. Do we have any other questions? Sid?
Yeah, I was going to ask, the problem with China in the past has been the accuracy of their numbers, the SEC reporting. So how much can we trust their numbers? I mean, I've lost money in Chinese names in the past, and so that's been a constant worry and a constant issue regarding the sanctity of their reporting.
It's a very legitimate question. Some very smart people won't touch it with a 10-foot pole, but sometimes you have to buy them when they're ugly. And I would not say that China is not without risks. In fact, a lot of the names that we talk about are kind of high risk situations. Duncan, are you there? Okay. Well, I think that we've got a short call today. Randy, do you have any questions?
No, nothing to add.
All right. Well, I want to thank everyone for joining us today, and we will be back next month with some more interesting ideas. Rich Gula was ill, wasn't able to join us, and Chang Q traveled to China, so a slightly smaller group than usual. But I thank everyone for joining in. I'm going to try to put together a summary and send it out so for those people who were unable to attend. Thank you all for your time.
Thank you.
Thank you, Tyson. Bye bye.
Thank you.
Thanks,
Thank you,
guys.
everyone.